Welcome to today's Explainer. We're jumping right in to dive into the surprisingly mysterious mechanics of business finance. Now, I know, usually just hearing the word finance makes people want to take a nap, right? But whether you're itching to start a side hustle, trying to invest smartly in stocks, or just want to understand how the corporate world actually ticks, this stuff is absolutely crucial. What we're looking at today isn't just math, it's actually a fascinating psychological puzzle.
Here's the core question. Can a business actually make a profit while at the exact same time losing money? At first glance, that sounds like an impossible contradiction. It feels like a riddle, but it's a very real, everyday phenomenon that happens in businesses all around the globe, and it's exactly the puzzle we're going to solve together today.
Section 1. The Anatomy of Business.
Okay, before we can solve our financial mystery, we need to quickly establish some ground rules about what a business actually is. It all starts with a concept called OPM. It's an insider term that forms the absolute lifeblood of any new venture. OPM stands for other people's money. You see, very few businesses start purely with the founder's own cash. They rely heavily on external funds. We're talking bank loans, supplier credit, investor equity, basically whatever it takes to get off the ground. If you strip any business down to its absolute bare bones, it's really just a massive, careful balancing act between what is owned and what is owed over time. Think of it like this. You take on liabilities, which is the money you owe. That could be a short-term supplier invoice or a huge long-term bank loan. Then you use that borrowed money to acquire assets, which are the things you own, like quick-moving inventory or long-lasting equipment. Let's bring this into the real world. Take a local coffee shop, for example. The owners put in 60,000 pounds of their own money, the bank lent them 40,000, and their suppliers floated them 10,000. That's a total of 110,000 pounds in financing. They immediately took that money and transformed it into 90,000 pounds worth of long-term assets, think shiny new espresso machines, and 20,000 pounds of short-term current assets, like the coffee beans and milk. The financing perfectly balances out the physical stuff. Make sense? Section 2. The profit formula. So now that we have a fully equipped business ready to go, how does it actually create value? Well, the basic formula seems like simple subtraction. It's just revenue minus your variable costs minus your fixed costs, which equals your profit. Basically, if you sell enough cups of coffee, your revenue covers your beans and your rent, and you make a profit. It's incredibly straightforward, right? But honestly, this simple math is completely lulling us into a false sense of security.
Section 3. The $900 illusion.
Let's absolutely shatter that false sense of security and dive into our core mystery. This is a fundamental paradox in business health that trips up even seasoned entrepreneurs all the time. Imagine a single, totally straightforward month of trade. And to keep things super simple, let's assume absolutely every single transaction was paid immediately in cash. Step 1. The business buys 1,000 items of inventory at $3 each. Step 2. They pay $1,000 cash just to keep the lights on and run the shop. Step 3. They successfully sell 700 of those items to customers at $5 each.
All right, quick mental math time. I want you to calculate the results based on those numbers. You spent $3,000 on items, you spent $1,000 on operations, and you got $3,500 in cash back. What is the final number? So, did you get negative 500 or did you get positive 400? Because, incredibly, both of these completely opposing answers are mathematically logical. Think about it. If you got negative 500, your logic was, I spent $3,000 on inventory plus $1,000 on operations. That's $4,000 out the door. I only brought in $3,500 from sales. Boom, I am down $500. But if you got positive 400, you probably thought, well, I only sold 700 items. Their cost was $2,100. Add the 1,000 for operations, and that's $3,100 in costs against $3,500 in revenue. Boom, a $400 profit. The first is a pure cash view, and the second is what accountants call an accrual view. And they both make complete sense.
Section 4. Solving the Paradox.
So how in the world can the exact same month of trade be both a loss of $500 and a profit of $400? Let's investigate. The math actually breaks down at a single physical point. We bought 1,000 items with our cash, but we only sold 700 items to our customers. This creates a massive gap between the physical cash we paid out, the $3,000, and the true economic cost of the goods we actually sold, which was only $2,100. So the absolutely crucial question here is, where are those missing 300 items and what on earth is their value?
300 items at $3 each gives us a pretty staggering $900 discrepancy. And here is the key to the whole illusion. Nothing was actually lost. That $900 represents goods the company still owns. It's sitting safely inside the warehouse as a retained asset. The business effectively just swapped cash for physical boxes. The wealth hasn't evaporated. It literally just changed its physical form from dollar bills into inventory. Now, when we add that retained asset back to our initial cash deficit, the two seemingly conflicting realities just perfectly align. You are down $500 in your bank account? Yes, absolutely. But you possess $900 worth of extra valuable stuff in your warehouse. Combine them, and your overall economic wealth has increased by exactly $400. You made a profit, even while you technically lost cash. Section 5. The two business brains. This reveals a truly profound truth about how organizations function. To truly understand a business, you literally have to think with two completely different brains. We call these the cash brain and the business brain. The cashier looks at the wallet, that's the cash brain, and asks, what happened to the money? Can we survive today? They're looking right at that negative 500. But the entrepreneur? They use the business brain. They look at what they own, the retained assets, and ask, did the company create overall value? And they see the positive 400. To operate effectively, leaders have to hold these two metaphors in their minds simultaneously. It's a balancing act. Cash is oxygen. If you run out of cash, you die today. You can't pay your employees, your suppliers cut you off, the game is over. But profit is purpose. If you aren't actually creating economic value over time, there's absolutely no reason for the business to exist tomorrow. You have to have both to thrive. Section 6. The financial dashboard. Let's move to our final synthesis and see how this builds into the ultimate toolkit used by professionals to monitor business health. This sort of financial X-ray lays our entire mystery bare, showing exactly how the two methodologies treat the exact same month of trade side by side. The cash basis looks purely at the movement of money, what went in, what went out. But the accrual basis looks at the economic reality, accruing, or basically counting, only the cost of the inventory that was actually sold to generate that $3,500 in revenue. Both methods are totally accurate, but they answer entirely different questions. And these dual perspectives map directly onto the three ultimate windows of a business, which we call the financial dashboard. You've got the income statement, which is your profit brain, measuring your performance. You have the cash flow statement, which is your cash brain, measuring your immediate liquidity. And finally, you have the balance sheet, which ties the whole shebang together by showing your overall financial strength. That balances out those initial assets and liabilities we discussed at the very beginning. We've seen today how a company can be incredibly profitable on paper while literally suffocating from a lack of cash oxygen in the bank. It's wild, right? So after seeing how easily profit and cash flow can tell two wildly different stories from the exact same month of trade, I'm going to leave you with this final thought to ponder. If you wanted to invest your own hard-earned money in a company, would you ever look only at its profit again? Thanks so much for joining me on this explainer, and remember, always keep questioning the numbers.